Hello and welcome to this webinar on planning for a no-deal Brexit, key risks and opportunities. I'm Andrew Webb, I'm the Chief Economist at Grant Thornton Ireland, and I'll start this webinar by giving an economic overview and a little bit of the context around not just Brexit but some of the other key issues at play within the economy that we're facing. My colleague Lee Squires, who's Head of Indirect Tax, will take up the topics on tax, customs and handling trade with the EU in a post-exit world. Lorraine Nelson will then move on to discuss regulatory compliance, and Susan Moylan will discuss the mobility of staff before Lorraine then closes out the seminar with a session on financial assistance. In this session I want to discuss with you the performance of the Northern Ireland economy, and within this session I'll discuss how the economy has shown improvement over a number of years since the crash, but that a number of concerns persist. Unlike the rest of the UK, the Northern Ireland economy has yet to recover to its position prior to the financial crisis, and there are concerning gaps with the UK on many fronts. Notwithstanding the strong labour market performance, we still have significant challenges around inactivity rates, lower productivity, and those are issues that are acting as a general and more consistent drag on the economy of Northern Ireland and our competitiveness as we move into a post-Brexit world. Within all that though, we do have the key issue of Brexit, and surprising as it might be to have to define Brexit at this point after so many years, it's always useful just to take stock as to where we are and what we're dealing with. So as we all know, Brexit is the process of leaving the EU, but there are some subtleties behind that in terms of how we transition, when we transition. As it stands, the transition period is up to 31st December 2020, and by that stage the expectation and the hope might be that we would have a new trading relationship with the EU, including new customs arrangements. The leaving of the European Union allows the United Kingdom to develop new trade relationships with third countries and move into a different trading environment, not just with the European Union, but able to strike out and strike new deals with the rest of the world. Other issues as part of the Brexit process are obviously the removal and replacement of EU programmes and structural funds, and those things that have invested in the likes of university research and lots of infrastructure projects over the last decades, and so there are big challenges and thought processes required as to how those are addressed and how those are replaced. The timeline for Brexit is, to the best of our knowledge, in this flowchart, and we would caveat pretty much anything we say in Brexit terms with regards to it could change overnight or it could change within hours. So to the best of our knowledge, this is the process as we understand it. Obviously there's the potential deal that Prime Minister Johnson has brought back from the EU summit this week, and at the time of recording Parliament is sitting in the coming days to vote on that. The timeline following that then would be that there's a process of transition that would lead to 2020, and by then there would be hopefully potentially a more consistent and a more firm set of trading arrangements with the EU. To move on though, to give a bit of a broader context as to where the economy is and how the economy is performing, this slide really drives home for us the key issues around where we are on a global economy context. And we discussed this in terms of what was a relatively calm global environment turning to one of much more chaotic and much more uncertain times. To explain this a little bit, the dotted line you can see there just at over 100 was the average of uncertainty in the global policy context in the whole decade 2000-2010. And you can see that we're significantly ahead of that and significantly more spiky in terms of how we are viewing policy uncertainty. To explain a little bit about what world uncertainty is, the IMF and Stanford have worked together to really trawl the Economist Intelligence Unit sources of writings on various countries' economic performance and policy and look for phrases relating to uncertainty, and that they've generated this index off the back of that. To give some comfort that it's not just a spiky line on a graph, they've also run regressions to plot this and see, is there a relationship between their definition of world uncertainty and global economic performance. And the conclusion is that there is a strong link, so that when we see spikes in global uncertainty, we also then see a downturn in global investment levels. And we're seeing that already in the global economy, and that's leading to more and more uncertainty, both from business community, and we're seeing more and more uncertainty from the consumer sector as well. Having painted a very bleak picture of global uncertainty, I would like to move on just to, I suppose, bring some positivity to the context, because in the face of all that uncertainty, Northern Ireland's economic performance has been particularly resilient. This graph shows Northern Ireland's composite economic performance, or in more simple terms, GDP, versus the performance of both Ireland and the rest of the UK. You can see that the Northern Ireland index in deep purple there has continued to demonstrate growth over the last number of quarters, and is averaging about 1.6% over the last number of quarters, and has had a consistent growth over the last 6 quarters, which is more than the other two comparators there can lay claim to. Obviously, though, you can see a very strong growth in the Republic of Ireland, and that has been driven by very strong export growth and very strong consumer trends. Northern Ireland's performance, while impressive on an output, while impressive and is growing, obviously very far off the pace there. So when we think about where we're heading next in economic terms, it's a very different path that we're heading into in the next decade compared to the one we've just experienced. Northern Ireland has had a very strong labour market in the last number of years. In fact, since the trough in around 2012 after the crash, Northern Ireland's added about 85 to 90,000 extra jobs to the labour market. So a really strong performance, and you can see that across various sectors there in the orange bars on that graph. The purple bars are where we expect the labour market to perform over the next decade. So as you can tell, looking at that, you can see that there was significant growth in what we term the recovery phase since 2012, particularly across sectors such as health, partly driven by an ageing population and more demands on the health service, but also strong growth across the private sector, in manufacturing, in professional and scientific type activities and administrative support type activities. To, I suppose, explain what those sectors are in more day-to-day terms, those would be the sectors such as consultancy houses, ICT, cybersecurity type jobs that Belfast shown particular strength in. It's coming through quite strongly in the numbers there. Manufacturing is a very interesting one and a very impressive performance for Northern Ireland, because I suppose there's a perception in the market and maybe in the media that some of the bigger manufacturing firms and the closures they've experienced might lead to a sense that it's a particularly tough time for manufacturing. And while there are certain very uncertain times ahead for the sector, it has come from a period of significant growth and is a major contributor to Northern Ireland's economic performance. And there's a very dynamic bed and cohort of smaller manufacturing businesses that are driving a lot of that growth, but we are seeing those very unfortunate headlines for some of the bigger manufacturers coming through in terms of redundancy announcements. Over the next decade, the sectoral strengths are expected to remain, but as we said, there's a much reduced scale of new employment coming through on the labour market. So we expect about 35 to 40,000 jobs between now and over the next 10 years. In terms of GDP growth, we're expecting that to come in at around 1.3% this year, 1.2% next year, and 1.2% in 2021. But I would again just caveat all of this in the context of we're not yet certain as to what path Brexit's going to take. So having looked at where we expect the labour market to go based on best estimations of employment and sectoral growth, we do see a number of different paths, obviously, for what Brexit might look like. And this slide sets out a range of possible new relationships that the UK has been and could seek with the EU in various discussions. In essence, the further to the left, the closer the relationship and the least disruption. To the right, the more disruption but greater autonomy for the UK. So where we ultimately land really is part of the ongoing discussions and will be hopefully becoming clearer in the next number of years. The government's aim, we believe, is for a relatively detached relationship with the EU, as indicated by the red outlined FTA box. Labour's view is that they support the membership of a customs union, but there's probably parliamentary support for the softest of Brexit options, which would be an economic area plus a customs union. So all to play for, and currently a lack of clarity as to where any of this will land, given what we all know around how the House of Commons has been voting and how the government's position has had to move just to try and get something through. And as various bills pass through Parliament, the ability for government to negotiate could tie their hands as we move forward. In terms of different growth scenarios and the impacts that these various paths for Brexit might have, there's a range of scenarios that discuss just how different the future prospects for the UK economy will be. And even in a softer Brexit, we're looking at a downturn, or an estimated downturn, or an estimated reduction in growth, probably more accurate to say, of around 2%. And in a harder Brexit, if you like, or a WTO rules type Brexit, we're talking about being worse off to the tune of 9% versus where we might have otherwise been had we not chosen to leave the EU. Sterling is something that gives cause for much thought in terms of Northern Ireland's position and where we're headed with Brexit and what the path might be for sterling. So there's been a lot of interest in the path that sterling has taken and will take, and you can see on that slide there the drop in sterling just after the result of the election. And you can also see how that hasn't recovered to that level since. It has been quite volatile and does tend to react depending on which news item emerges and which deal seems to emerge and how Parliament behaves. So sterling is acting as a bellwether in terms of where we're heading with Brexit, but as I said, hasn't recovered back to anything like the levels of the pre-EU referendum. And what might that mean? Well, a weaker sterling has traditionally been seen as a good thing for exporters and a bad thing for importers. And the structure of the NI economy and our exporting and importing patterns means that that's a reasonably simplistic analysis which doesn't capture the full intricacies of an all-island trade situation that we currently operate within and currently enjoy. And just to unpick that a little bit, just over half of Northern Ireland exporters also import. And so it's difficult to be definitive about the impact on NI exporters in terms of a downturn in sterling, as it will also depend on increased cost of goods and the various services that they have to import and the extent of their importing activity, and just what the balance would therefore be between how they engage with the domestic UK market and how they engage with export markets. So depreciation in the value of sterling would also make household goods imported into NI more expensive, and those are numerous. Over time, this could result in higher rates of inflation, or if such rises are not tolerable and not able to be passed on to the consumer, that sort of inflation then could lead to a monetary policy activity that could impact on interest rates. Again, I suppose we can't caveat enough just the extent to which we're in an uncertain period. So these are all possible scenarios, and I suppose we think about it in a no-deal situation, and anything better than a no-deal situation obviously mitigates some of this more bleak assessment of where we could end up. Just on sterling, and to continue a thought around where spending patterns and households might be impacted. Northern Ireland's been relatively more affected by inflation compared to other UK regions in the last number of years, based on analysis by the Department for the Economy, and that's really because NI households spend relatively more of their incomes on food, clothing and fuel, and they're broadly imported. So those key elements that Northern Ireland consumers spend on are more exposed, if you like, to the vagaries of a sterling exchange rate depreciation or appreciation. Also tourism, often when we hear of a depreciation in sterling, we start to see more media around cross-border shopping and a boost to tourism, and those are two key areas for the local economy. Again, it's difficult to be definitive, as the past benefits as to whether or not the past benefits would be replicated in a no-deal context. Given that pressure on NI household spending power that I mentioned, that also may mean that the traditional benefits of increased UK households holidaying within the UK may not materialise. There may be a contraction that's UK-wide if there's an impact on sterling. And while depreciation of sterling could increase the number of Irish residents shopping in NI, it could also be complicated by potential cost increases of imported goods in NI and uncertainty around customs and VAT requirements when bringing goods back over the border. In addition, for migrant workers, which have been key to some of Northern Ireland's sectors, particularly the hospitality sector, the depreciation of sterling could impact on the attractiveness of taking up employment opportunities in Northern Ireland. And we have seen some evidence of that, where some key sectors have really struggled to find the labour sources that they would have previously relied on from outside Northern Ireland. So the extent to which EU26 migrants are working in Northern Ireland has been impacted already by this decline in sterling and could be compounded further under a no-deal scenario. On trade, and moving on to just the potential impacts on trade, Northern Ireland purchases and sells more to GB than any other destination, and there's been lots of discussion during the course of the Brexit negotiations just about the various flows of trade between Northern Ireland and GB and Northern Ireland and ROI. In 2017, GB sales in goods amounted to close to 8 billion, just under 8 billion at 7.6, and it was 10.5 billion in purchases from GB. With regards to the purchases and sale of services, 3.7 billion in service sales and 2.8 billion in service purchases. So the GB market is crucial to Northern Ireland. NISRA estimates that of the 7.6 billion of goods sold to GB, which excludes farming, 29% were manufactured agri-food products, and the majority at 71% were in other manufactured products. In terms of the 3.7 billion in services sold to GB, 45% were in construction and a significant proportion in transport. So a large proportion of the value of Northern Ireland's goods and services go to GB, and a lot of that can be attributed to a small number of businesses, about 169 businesses engaged in that, which are accounting for about 40% of that trade flow. Ireland is Northern Ireland's biggest export destination and an important first market for exporters, and a key policy challenge for Northern Ireland is to try and get more companies exporting, and gravity models would suggest that you do more trade with your nearest neighbours, so the Irish market is a particularly crucial one for lots of traders, but also the policy ambition to grow Northern Ireland's export base and get people operating in external markets. In 2017, total exports of goods and services to Ireland were valued at 3.9 billion, and that's 39% of all exports. It's food and live animals which are the top goods that are exported to Ireland, and that's worth about 32% or 1 billion of total Northern Ireland good exports to Ireland. Services exports to Ireland increased by 28% since 2016, and they're just shy of 1 billion at this point. And approximately 44% of those services are sent to Ireland, and it continues to be Northern Ireland's largest service export market. The Irish market is also an important destination for agri-food. For food and drinks processors, it's the largest export market, accounting for more than half of the exports. For the farming sector, exports to Ireland totaled 61 million. And to delve into that a little bit, sheep slaughter alone totaled nearly 35 million. Just to give a sense of just how important those sectors are and the all-island economy. Almost 8,700 businesses in Northern Ireland sold goods and services to Ireland in 2017, and many of those were micro businesses who employ 0 to 9 employees. They accounted for 2/3 of the businesses exporting to Ireland. So there's a significant challenge there in terms of the markets that Northern Ireland plays into, both in GB and ROI. And in a no-deal scenario, the difficulties in trading, based on analysis, have estimated that there could be 40,000 jobs at risk from a no-deal Brexit. Now that analysis, when you put that in the context of we're expecting additional jobs in the next decade to be around 40,000, if there's a no-deal Brexit, you could then be talking about no growth or a downturn in the labour market and a proper downturn recession territory in the economy. So the impact of EU tariffs could reduce Northern Ireland's exports to Ireland by 11% based on that same analysis by the Department for the Economy. But there's also the impact of non-tariff barriers and extra admin and extra bureaucracy that could also see a decline of 19% in Northern Ireland's exports, and just the additional burden of doing that might put a lot of people off. And also you can get into issues of origin, certificates of origin, and you know how that works through the supply chain is potentially a significant impact. So no deal therefore places a twin pressure on Northern Ireland's access to the EU and the UK markets, leaving businesses with very limited options, and the NI economy facing potentially an absolute reduction in exports and external sales under what we're calling the no deal scenario here. Tradable services we see as similarly exposed. Businesses exporting services to Ireland would face an average increase in the cost of doing business of just shy of 15 percentage points. And that's particularly vulnerable when we think about where we've driven our economy to in the last number of years, particularly ICT and, as I said, cybersecurity, and those have been key growth sectors. They're tasked with, I suppose, growing the Northern Ireland economy and driving us towards a more productive economy, and the potential downturn in performance there could be significant. And then under a no-deal scenario, Northern Ireland's FDI attractiveness would be very much negatively impacted, and there's been great successes in being able to attract inward investment over the last number of years. So on the basis of Department for the Economy analysis and on the basis of what we've gleaned from potential impacts in terms of additional bureaucracy and tariffs and the imposition of those, we could see that a significant potential downturn from those various impositions on business. That's not to say that business will suddenly crunch to a grinding halt, and there are always ways that need to be thought through in how to address these challenges that lie in front of us. And in the remainder of this webinar, you will hear from colleagues about some of the practical issues that need to be considered in engaging with dealing with the European Union market and dealing in trade with the UK. And you'll hear about the financial opportunities and also how to consider your labour market and the people that work with you.
I'm now going to talk about the tax, customs and tariffs issues for businesses trading with the EU after Brexit. So this presentation assumes that there will be a no-deal Brexit on the 31st of October and sets out what businesses can do to plan for that eventuality. So a no-deal Brexit implies that there will be a cliff-edge change on Brexit Day and no transitional period, and trade between the UK and EU will be on third country or so-called World Trade Organization or WTO terms from the 1st of November. This means goods will be subject to customs processes and controls and customs duty when they cross the border into the UK or from the UK into the EU. And businesses who have only traded with the EU will need to devise new systems and bear new costs. UK businesses will also lose access to the EU's set of free trade agreements. So looking at the customs processes, businesses will need an Economic Operator Registration and Identification, or EORI number, to import and export. Luckily, HMRC has automatically allocated these to most businesses with a history of trading with the EU. But if you don't have an EORI number, you should consider applying for one now. You will also have to submit import and export declarations in relation to each consignment. Now, businesses need to consider how they will comply with those obligations. Most businesses will use a customs agent or a freight forwarder if they want to do this themselves, and they will need the relevant special software and to train their staff to do this. Fortunately, however, the UK government has introduced a simplification known as Transitional Simplified Procedures, or TSP, which give businesses a deferral in having to comply with these obligations. As of this week, the government announced that all eligible VAT-registered UK-established businesses would now automatically be enrolled for TSP, so you don't need to apply unless you haven't received notification from HMRC. And under TSP, for standard goods, which are most goods, you only need to make a simplified import declaration in your records on import. You then have to make what's known as a supplementary declaration on the 4th working day of the following calendar month and pay any duty on the 15th day of that month, provided you also apply for a duty deferment account. And what's new is that you can now choose to initially defer those declarations until the 6th of May 2020 and payment of duties until the 15th of May 2020. So that's almost a 6-month deferral, and this should give businesses plenty of time to prepare to make the necessary customs declarations and pay any duties. Of course, as well as processes, what you really need to know is what tariffs will be payable on your goods. So if you're exporting to the EU, that's an import into the EU. So the EU tariffs are determined by a classification system known as the combined nomenclature, under which each product is classified with a 10-digit commodity code. And if you work out the 10-digit code, then you can determine the tariff, the duty due under the EU tariff. This is not always straightforward and can be complex, particularly where there are multifunctional products. Many businesses have commodity codes that they use in their intrastat returns. However, we would suggest caution in assuming that the codes used for intrastat purposes are correct, as they've only been used for statistical purposes to date. When you're importing to the UK, the government has announced a temporary import tariff that will apply in the event of a no-deal Brexit. This eliminates or reduces duties on many goods in order to protect consumers and will apply for up to 12 months following Brexit. One impact that's often overlooked is that this means that there is a reduction in tariffs on non-EU imports. This means that UK industry faces competition from cheaper imports from some countries, like China, for example. If the tariffs you face are significant, you may also want to consider the availability of customs special procedures and reliefs that could be used to mitigate the tariff impacts. These include transit relief for goods moving from the EU to the UK and shipped back to the EU, which allows goods to move in duty suspension without full customs declarations being made, customs warehousing, for example, to avoid double taxation on goods bound for the EU, which are moved into the UK but not released for circulation in the UK, and then inward and outward processing relief for manufacturing in the UK using EU components. Finally, temporary admission relief may be useful where goods are moving temporarily into the UK from the EU or vice versa. Let's now come on to look at the VAT changes that will be relevant in the event of a no-deal Brexit. So in this case, the UK government has said that they will introduce postponed import VAT accounting. This means that VAT on goods imported from outside the UK will be accounted for by traders on their VAT returns rather than when the goods cross the border. This effectively avoids the cash flow cost of having to pay VAT when the goods cross the border and then reclaiming it on the return. This will also apply to imports from non-EU countries, which will be a cash flow saving compared to the current position. There will also be changes for distant sales to consumers, i.e. things like e-commerce goods sold online and digital services. And in some cases you may need VAT registrations in other EU countries if you want to deliver duty-paid products to your customers. Many businesses may come VAT cross-border refund claims, also known as 8th directive claims, in respect of VAT they incur in other EU countries. These are made through HMRC. Normally the deadline is the 30th of September of the following calendar year. However, if we leave the EU without a deal, then this directive procedure will no longer be available to UK businesses. We're therefore recommending that businesses make all of their outstanding claims to HMRC by the 31st of October. You should also prepare for the new evidence needed to zero rate your exports to the EU. I'm now just going to talk briefly about the special considerations that apply to the Northern Ireland border. What I've said so far applies generally to trade between the UK and the EU. So from a customs perspective, the UK has said that it would not apply customs formalities or duties on most goods coming into Northern Ireland from the Republic of Ireland, although declarations would be needed for controlled or licensed goods and those subject to excise duties. This would only apply for a temporary period. It's important to note that these arrangements are not reciprocal, they're unilateral arrangements that the UK has announced. This means that imports into the Republic of Ireland from Northern Ireland would still be subject to customs duty and controls. From a VAT perspective, VAT will apply normally to VAT-registered businesses in Northern Ireland importing goods from the Republic of Ireland. Those businesses can use the postponed import VAT accounting procedure I described earlier. Finally, let's just consider what should Northern Ireland businesses should do now to prepare for a no-deal Brexit from a customs and VAT perspective. Firstly, they should consider how they will submit import and export declarations and comply with the transitional simplified procedures. They will also need to consider their commodity codes and the relevant tariffs on both their imports to the UK and their exports to the EU. You should consider which party is responsible for import formalities and paying any duties, and whether that's you, your supplier, or your customer. You may want to look at your contracts and determine who is responsible for this, and also look at whether you need to change any contracts going forward in anticipation of Brexit. If you wish to act as the importer of record into EU countries, for example to deliver duty-paid products there, you may need a VAT registration in those countries and an EU EORI number. You should also think about applying for the customs reliefs I mentioned, consider the VAT changes, and also consider the impact of the loss of their access to the EU's free trade agreements.
Now we're going to look at the things you may want to consider in the event of a no-deal Brexit in relation to regulatory compliance, supply chain, and the ability of you to deliver your goods to your customers within the EU. So firstly, we'll look at the sort of regulatory compliance pieces and things that companies could maybe do now to implement those changes within the company and be ready for a potential no-deal Brexit. So for example, the likes of the conformity of products, firstly it is make sure you secure the conformity of your products and they are recognised EU standards. You may also want to look at the national standards of certain EU countries that you export to and check to see what is required there. In a temporary basis, the UK government have notified that they will allow you to sell EU tested goods within the UK for a short period of time, although that period of time has not been disclosed as yet. The UK government will also be installing a new UK standard testing body, which will be called UCAS. And that's something that if you are selling products within the GB market, that will need to have that stamp on it going forward. So it probably is best to speak to your testing body and maybe change that testing body or check to see if your self-assessed CE marks, those books need to be transferred to an EU country after Brexit. It probably is also make sure that your products are marked with the new EU recognised notified bodies 4-digit number, and any new certificates are issued with plenty of time before Brexit happens. It's also worth noting that for each specific sector there is quite a lot of information on the UK government's website, so it's worthwhile checking out www.gov.uk/Brexit and just type in your sector and look at the no deal advice that is available there. It's worthwhile just maybe looking at your current plans and maybe reviewing those and maybe changing those if there's anything there that may stand out that you may want to look at. You may also want to review your approach to data. I suppose the most relevant safeguard for data transfer between the EU and the UK is the use of model contractual clauses, which have been approved by the European Commission. If you insert these within your contracts, this will ensure that you're able to have a free flow of personal data. The major issue here is that if the European Union does not decide that the UK, when it leaves the European Union, is not an adequate party for the flow of data, It's worth checking out the UK Information Commissioner's Office has also got some template clauses that you may want to insert into any contracts that you may have for surrounding the flow of data. In respect of your contracts, it's always really good to sort of have a look to see where you have existing contracts. That could either be with customers, suppliers, even the likes of insurance companies. You will have contracts there, and just checking to see what those contracts say, if there's any references to the EU, and what clauses they have, especially in relation to the tariffs and any additional duties, and if there's any penalties for delay in the supply of goods. So if you want to maybe review those and then renew those with new contracts, and try and keep them as flexible as possible to allow for movements in inflation, exchange rate, and also maybe have those in currencies that are not fluctuating as much, for example, like the sterling has been recently. Most importantly, in relation to the supply chain, every single part of the supply chain will change. All suppliers will be impacted by the effects of Brexit. So it really is important that you review your supply chain, and not just your direct suppliers, but also look back on your back to end-to-end supply chain to ensure to really know where your products and supplies are coming from. Are they coming from the EU via a GB supplier or distributor, and then finally making its way to Northern Ireland? So really, you also want to look at sort of assess the financial stability of your supply chain, and have a look to see if there's any suppliers that may be vulnerable to the impact of Brexit, particularly around any additional tariffs or supply chain costs, and then try and develop a contingency plan around that. What we've seen is some people maybe seeking alternative suppliers, extending their supply chain finance, or maybe supporting their suppliers in different ways. And in some cases, it may be an opportunity for you to expand and purchase those distressed suppliers. In respect of your planning for forecasts, it's always good to have a look at between sort of the 6 to 12 week potential disruption and just-in-time delivery. So maybe you need to want to look at your sales contracts that will be happening in the next 6 to 12 weeks, and maybe stockpile any key components or sundries that you may require to manufacture those goods. Would also have a look to see whether you need to check to see if there's any delivery routes that may want to be changed for that, and then also extend lead times. Again, that sort of falls within your contracts, to maybe push out some of those deliveries or push them forward prior to Brexit. And maybe consider whether you should send out larger or smaller consignments may work better for you. The main thing here is also communication. It's also really critical to identify those major suppliers and who are critical for your manufacturing or retailing of goods. So do speak to those and find out how they're prepared, especially in relation to a no deal. Specifically their logistics, customs, other people, are they able to staff their facilities, and even if they checked with their own suppliers. It's also good to sort of share your Brexit plan with those suppliers just to make sure everything is joined up. And then also have a list of alternative suppliers that you may wish to bring on board. But I suppose communication with your supply chain, both your customers and your suppliers, is critical surrounding your Brexit plans.
Hi folks, I'm going to be talking today about the mobility of staff post-Brexit. So I think from a people perspective, Brexit, as with any other period of sustained uncertainty and change, communication is absolutely key. If your workforce don't hear messaging about your Brexit plans via formal channels, they will pick up information from the rumour mill, which may not be that accurate. And as we all know, people never perform at their optimum when ambiguity exists. Now, we've talked a lot today about planning for Brexit, and I strongly believe that Brexit planning is just good business planning. It's about making no regret decisions, and from a people perspective, it's exactly the same. In a deal or a no deal scenario, one thing for sure is that you will still have people in your business now and beyond the 31st of October. So control the controllable. From the people perspective, Brexit is absolutely an opportunity for you to ensure that all of your people strategies are as good as they can be. When I help clients, I encourage them to think of the employee life cycle, from attracting the best talent to when an employee exits and everything in between. You need to ensure that the greatest asset of your organisation, and that's your people, you need to make sure that those people are fully supported throughout this whole process. Make sure your attraction and selection strategies are fit for purpose now and in the future, given the new immigration rules. And when your workforce are on board, give them meaningful learning and development opportunities. Basically, what I mean here is make yourself an employer of choice, and this goes beyond simply focusing on salary offered. I will now focus on a few of the key issues and a few suggested actions to take regarding your people. So some of the key issues: retaining EEA nationals. It is likely that both economic and cultural factors may lead to many workers returning home. This could lead to staff shortages within your organisation. Recruiting workers. Due to the continued uncertainty and relatively lower wages, it is possible that it may be harder to recruit new staff. We could see rising labour costs. With an increase in the demand for specific skills and a reduced supply, it could lead to wages rising, and therefore your overall wage bill will rise as well. Skills shortages. The skills to navigate the new regulatory and compliance requirements do not necessarily exist in organisations at the moment. This could be an issue. And now, in terms of some actions that you can take in terms of your people, the first thing I would say is conduct a residency audit. Understand who in your workforce is likely to be affected and what residency or permits they might be entitled to. And remember, this includes people's families as well. Communicate clearly. Ensure your employees are aware of their rights to remain and the need to apply for settled status before the deadline, and support them with this process. We suggest that you conduct a full review of your current and future people's strategies to ensure these are as good as they can be. As I said, control the controllable. It's important that you upskill your current workforce and make use of any grants available. For example, the government customs training grants, which can range from £750 to £1,050 per person, are 50 to 70% of the cost of customs training. And the last piece of advice is position yourself as an employer of choice. What this basically means is review your reward and benefits approach to maintain competitiveness in the labour market. Ensure your employee value proposition is as attractive as it can be by developing and reviewing remuneration packages, benefits and incentive schemes with an increased focus on non-cash benefits.
So we probably have given you quite a lot of information through the course of this webinar, and there is also financial assistance available to Northern Ireland businesses to help them prepare for Brexit. In particular, the Invest NI have a Brexit preparation grant, so they will support costs, 50% of costs up to £50,000. And there's a really wide range of use for this money. So you can develop your Brexit contingency plans, and specifically around Brexit related risks such as supply chains and procurement, customs, tariffs and taxation, export market opportunities, access to skills and labour, contractual arrangements and transport and logistics. If you are an Invest NI customer or client, it's best to speak to your client executive and they will be able to help you apply for that grant. Intertrade Ireland also have two forms of assistance to small and medium-sized enterprises who are based in Northern Ireland and trade with the Republic of Ireland. Firstly, there's the Brexit Preparedness Voucher, and that can give you professional advice of a value up to £2,000 including VAT, and can also be used as a part payment for any advice you may receive from professional advisors. Following this, you can also apply for a Brexit implementation voucher. So following those, the preparedness voucher, you may have a very draft Brexit plan, and there may be something in that you want to actually implement within the business, and you can use this voucher to assist you, and it will give you 50% of funding of up to £5,000 for professional advice as well. So it really is worth while having a look at those and see if you could bring those into your business. And finally, we'd just like to thank you for listening to our high-level Brexit webinar today. If you have any queries, please do not hesitate to contact us.